Hello everyone, welcome to Brilliant Bankers. Today we will be discussing about the chapter Introduction to Treasury Management. Before getting ourselves introduced to Treasury Management, let's basically know what is a treasury. So treasury is typically a government department which is responsible for managing a country's finance or a state's finance or a town's finance. So each and every town does have a treasury of its own. So it is a government department that manages finance. The primary functions of a treasury are financial management, that is for the growth of the place and for the collection of revenue, for budgeting and the expenditure control. It also does the cash management process, managing the government's cash flow to ensure that there is enough liquidity to meet the financial obligations of the government. It also manages the debt by managing the government's debt, which includes issuing bonds and other debt instruments, and also developing strategies to optimize the government's debt portfolio. It also deals with the risk management of the government by engaging in risk management activities to mitigate the financial risk associated with the currency fluctuations or the interest rates and the other factors that affect the currency, helps in the financial planning and also the banking and financial services. The treasury works with the financial institutions to manage the government accounts, invest funds and execute the financial transactions. So this is what a government treasury is. But today we are going to learn about the treasury management in banks. So conventionally the treasury function was confined to funds management, maintaining adequate cash balances to meet day-to-day requirements, deploying surplus funds generated from operations, and sourcing funds to bridge occasionally gaps in the cash flow for the government. But in the context of the bank, the treasury is also responsible to meet the reserve requirements, like that holding the cash balances as per the CRR and the SLR as set by the Reserve Bank. So on date, the CRR is 3.35% and the SLR is 6.15%. So the treasury has the role of holding the minimum cash balances as required by the CRR and the SLR with the Reserve Bank. Thus, the treasury function was essentially liquidity management, and from an organizational point of view, treasury is considered as a service center for all these things. The treasury also plays an active role in the ALM management, that is the asset and liability management, and with its constant exposure to the markets is well placed to advise the management of the bank for taking the internal decisions in product pricing and also the strategic investments also. Treasury especially deals with the short-term fund flows, with the exception that as part of the SLR requirement, the statutory liquidity ratio requirement, investment in some securities is held to maturity exceeding more than that of the 1 year. So some of the functions of the, let's discuss about the functions of the integrated treasury. And before that, let's see what the integrated treasury is. So integrated treasury is a banking setup, refers to integration of money market, securities market, and the foreign exchange operations. So automatically in the banking sector, an integrated treasury refers to a unified and comprehensive approach to managing various financial functions within the treasury department of the bank. So this integration involves a seamless coordination of the activities related to the cash management, risk management, liquidity management, and the investment management in the banks. So the goal is to optimize the bank's financial resources and ensure effective decision making for the banks. So coming back to the slide, integrated treasury is the direct result of reforms in the financial sector, The most important reforms being deregulation of the interest rates and the partial convertibility of the rupee. On date, as rupee is a freely convertible on current account and to a large extent also convertible on capital account in the case of the forex transactions, owing to major relaxations that has been allowed by the Reserve Bank in all the areas like the FDI, the ECB, and the overseas direct investment by the Indian corporates and the foreign currency operation of the resident Indians. So banks have been allowed large limits in proportion to their net worth for overseas borrowing and the investment also. So we can also state that the driving force of the integrated treasury as the integrated cash flow management, the interest arbitrage, access to global resources, and also corporate demand for high-end services and risk management. So what are these? The key components of the integrated treasury in the banking sector. So the key components are the cash management, the risk management in the bank, the liquidity management of the bank, managing of the investments in the bank, compliance and regulation. That is ensuring that all the treasury activities comply with the regulatory requirements and the banking standards. Also, the technology integration by utilizing advanced technology and systems to integrate and streamline the treasury operations, which can also include the use of the treasury management systems, that is the TMS, and other financial technologies to automate the processes by enhanced reporting and also improve the overall efficiency in the bank. It also helps in the communication and coordination of different things. So an integrated treasuries approach is crucial for banks to adapt to dynamic market conditions, optimizing the returns of their financial assets and effectively managing risks. It helps create a more resilient and agile financial institution that is capable of navigating the complexities of global financial landscape. So coming to the functions of the integrated treasury. The treasury activity which we had discussed as a main functions of the meeting the reserve requirements as a CRR and the SLR. We have already discussed this, that the main function of the integrated treasury is to maintain or meeting the reserve requirements as set by the RBI, that is the CRR and SLR requirements to be maintained. Global cash management, that is the fund management or the cash management in the banks. Efficient merchant services, which include the forex and the advisory services. The merchant services that are given by the banks, that is like the forex services. On date, the banks are also helping the security markets, or they are having the demat accounts in this one, optimizing the profit by exploiting the market opportunities in all the three. There is a forex market, the money market, and the securities market. So what is the securities market? Which includes the debt, equity, and credit of the derivative markets. Risk management, that is managing the risk of the bank or the entity. Also assisting bank in the asset and the liability management, that is the balance sheet management. So consolidating it together, the treasury activity thus encompasses the fund management, investment, forex operations, trading, and risk management in a multi-currency environment. For this, we may add the evolving role of the treasury in managing the balance sheet risks also, in coordination with the other departments and the roles of the treasury in the banking sector. Coming to the roles of the treasury in the banking sector, the main roles are the liquidity management, the proprietary functions, and the risk management. So what is a liquidity management? The treasury is responsible for managing short-term funds across the currencies and also complying with the reserve requirements. So automatically the main role of the treasury is to comply with the reserve requirements, that is the CRR and SLR. When you are complying with the CRR and the SLR, managing of short-term funds also become a compulsory duty of the treasury. Proprietary positions. The Treasury may trade in currencies, securities, and other financial institutions, including the derivatives, in order to contribute to the bank's profit. Here, coming to trading of currencies, when US dollar is being remitted in the bank, the Treasury has that fund, which, in other words, gives the same fund on loan to some other customer, from where the Treasury gets an income, which also contributes to the bank's profits. Risk management. Treasury will aid the management in bringing the asset liability mismatches and will provide the derivative tools to manage risks in the client's business, and will also manage the risk inherent in its own proprietary positions also. The multiple roles necessitate Treasury to manage an ALM book for internal risk management, a merchant book for a client related currency and the derivative transactions. So merchant and ALM book is to be maintained for the internal risk management, a merchant book for the client related currency and the derivative transactions, and a trading book for managing its proprietary positions also. So ALM book also includes the traditional role of the treasury in liquidity management. So within the framework that we have set above, this is what are the functions of the treasury, and we will also discuss about the same in the upcoming videos also. So what is the process of globalization, and how does globalization affect the treasury process? Globalization is a principal factor contributing to the integration of the treasury activity, wherein globalization refers to the interaction between the domestic and the global markets, and may generally be defined as the process of integrating domestic market with that of the global markets, characterized by free capital flows and the minimum regulatory intervention. So globalization that happened in India in the 1990s, only after that there has been a big boom in the business in India, only after which a lot of foreign direct investments have started coming into India. On that note, it so so that is what is called globalization. New norms were formed for which investment can be done in India, and corporates of India can invest abroad. So the process of integrating both the market, the domestic market with the global market, is known as globalization. The fund flows on capital account may take one or more of the following route. When the capital account investments are being done, so there are different routes which can be used for the flow of the funds. One is through the portfolio investment, wherein the foreign investors investing in domestic equity and debt markets can invest directly. The direct investment, foreign companies and foreign institutional investors investing long-term funds in the domestic companies, new projects, or the manufacturing facilities. Also for business processes outsourcing, wherein the foreign companies they can invest for the budding new companies or for any startups also. For their manufacturing facilities that is in India, for example, a lot of car companies are producing their cars in India and exporting abroad. You can take the example of Kia, which is having its production in India and they're exporting it from India. So manufacturing facilities are in India. Business processes outsourcing, like TCL and other things. TCL is an Indian company, but Google is doing the same, where it is doing outsourcing from India. The external commercial borrowings, which was explained earlier in a video, the issue of equity in global markets. What is issuing of equity or debt in global markets? This is by taking the ADRs and DDRs. Mergers and acquisitions involving the domestic and the foreign entities. When a foreign company takes over a Indian company or a vice versa, as and when Tata was taking over the land JLR, the Jaguar Land Rover. So these kind of mergers and acquisitions was all due to the effect of the globalizations. the payment of technology transfer, royalties, and the financial transfers, etc. All the above transactions involve the payment and receipts of interest, fees, dividends, and the repatriation of the capital denominated in the foreign currency. Sometimes they are transferred cumulatively, referred to as a transfer of savings. The capital flows impact money supply, interest rate, exchange rate, inflation expectations, and the balance of payment in the domestic economy also. Though the capital inflows supplement domestic resources, the implement is not always the benign. Whenever there is a sudden rise or fall in the portfolio investments, this may lead to increase in the volatility of the stock prices or interest rates and the exchange rates, which thereby increasing the risk to the investors. All these are being monitored by the FEMA Act, which FEMA Act of 2000, which replaced the FERA Act. Coming to the RBI on IRF. What is an IRF? It is an interest rate futures. The currency and the IRF credit swaps have been introduced under the combined stewardship of the RBI and the SEBI. The currency futures are being traded in two major exchanges. What are the two major exchanges? That is the NSE and the BSE, with fairly good liquidity to 1 to 3 months contract. The maximum contract period in both NSE and BSE is 3 months. So interest rate futures market has also been activated with the trading in the IRF on a notional coupon bearing a 10-year Government of India security, which was introduced in the year 2009 in the stock exchanges. So in 2013, the RBI allowed IRFs deriving value from their underlying stocks or the underlying securities in the recognized stock exchanges, like the 91 days treasury bill, the 2 years, 5 years, and the 10 years coupon, which was bearing the Government of India security. So where the risk is less and the investment can be done on the with the risk on the Government of India and the coupon bearing the Government of India security. So all these were being issued by the Government of India itself. So RBI had given a go ahead to the interest rate futures. What is Treasury as a profit sender? So Treasury was a service sender primarily intended to attend to the cash flow requirements of a bank, and it always operated only in the money market. So merchant business was attended through the foreign exchange department, while banks investment assets were managed through a separate department. But on date, all these three, the forex business, the money market deals, the investment activities, and the profit of contemporary, all these three, sorry, forex business, money market deals, and the investment activity are being dealt by the treasury center. So what is the forex business they are dealing? They are buying and selling of foreign currencies to the customers, which constitutes a major source of the income for the banks. The difference between the buy sell rates is known as a spread and is the profit of the bank. So that spread is the profit of the bank. The spread between the buy and the sell rate is the profit of the bank. It can be also the vice versa. Coming to the money market deals, it is a conventional banking operation in the money market, which has been confined to lending surplus funds and borrowing funds when required. Interest on the funds lent in the market is a source of income for the bank, but it can hardly be called as a profit, as such funds come from deposits, where interest cost is higher than the interest earned in the money market. That is, when we have a deposit of 100 crore, you can maximum go for a loan of 75 crore or 70 crore, because you do also have a conditions of the CRR and SLR to be maintained. So when you are going or giving a loan of 70 crore, what will be there will be a small interest difference. So what is going to be the income of the company? That is what is called as a money market deals. The investment activity. Banks have always been investing in the government securities to satisfy the SLR requirement. So how do the banks get out from the SLR requirements? By investing. So to satisfy the SLR requirement. But otherwise, we are not very active in investing in the non-government securities. Income from the risk-free investments was not considered to be a significant at all in any cases. So banks have always been investing in the strategic assets such as the subsidiary and the associate companies, where returns on investment were only of secondary importance. So investment activity by banks are done in the government securities to satisfy the SLR requirement. And other than that, banks do not go for any other non-government securities other than investing in a subsidiary or an associate company from where they can get some kind of income or a profit. So what is the profit of the contemporary treasury? What is the main role or what is the profit of a treasury? It's buying and selling foreign exchange to customers and interest on the investments and money market lending, which continues to be the primary source of income for the bank treasuries. So bank treasury is always buying and selling the foreign exchange, and any amount that is being lent and the income from lending of that money is the main source of income for the treasury. Coming to the interest arbitrage, the treasury operates across the currency and different security markets. So in this position, to find where the interest differentials are in a favor. If you have observed, the price of a same script in both NSE and BSE at the same time will be different. There will be small difference in NSE and BSE. So arbitrage is that activity that is buying and selling of the same product at the same time, but in different places. That is buying a script in NSE and selling the same immediately in BSE, buying it from National Stock Exchange, selling it in Bombay Stock Exchange. You get a small difference of a mere difference of maybe 5 paisa or 10 paisa. But when the lot size is high, you get a higher interest. That is, the treasury may borrow in the US dollars and lend the money in rupee in the intermarket branch. So what happens when it is taking loan in US dollars? It's paying less, and when it is selling it out, it gets more, depending on the domestic and the foreign interest rates. Or the treasury may borrow in the money market and invest in short-term commercial papers or the treasury bills also. What is a trading activity? Trading is a speculative activity where profits arise out of the favorable price movements during the interval between the buying and selling. So trading is automatically done in a stock market. Treasury products. Treasury sells, in addition to foreign exchange services, derivatives and structured products to corporate customers and also to large corporates. So these are the ways how a treasury yields profit. That is by the forex business, the money market deals by lending the money, by investment activities in government securities, creating profit through the interest arbitrage, through trading, and through different products by selling the foreign exchange services and the derivatives to the corporate customers. So, what is an organization of a treasury? What is the organization structure of a treasury? The treasury is organized either as a department of a bank or as a specialist branch under the direct control of the bank's head office. So the treasury functions with a degree of autonomy with its own accounting system. So treasury is a separate branch which comes directly under the head office, and it has its own accounting system wherein it is not linked with any other branch, and the branch status is preferred as the books of accounts of the treasury can be maintained independently. This also has a separate status of a bank. So treasury is a separate branch which is never aligned or mixed up with any other branch in the same locality. And treasury always comes directly under the bank's head office. Treasury as a specialized branch enjoys an additional advantage as the bank can act as an authorized dealer for foreign exchange businesses also, and can also participate in clearing and settlement activities or settlement systems directly, while the head office department can act only through the branch of its business operations. So, therefore, we can conclude that in the context of the integrated treasury operations, a treasury branch is always a preferred form of organization. The treasury is segregated into three main divisions: the dealing room or the front room, the back office, the mid office, and it is also having a investment department. So, coming to the dealing room, and let's go through it in detail. The dealing room and the front room. The terms front office, back office, and mid office are commonly used in the financial institutions to describe different functional areas where the organization each have specific role and the responsibilities. Coming to the dealing room or the front office is the client facing part of the financial institution, which is responsible for generating revenue and facilitating the transactions, which is head by a chief dealer who is in charge of the front office. The dealers working under him buy and sell in the market. It includes activities which relates to sales, trading, and the customer service. In a dealing room, which is a specific type of front office for trading activities, traders execute buy and sell orders for various financial instruments such as the stocks, bonds, currencies, and the derivatives. The front office also plays a crucial role in the revenue generation and directly interacts with the clients, making it a key component of the financial system. So normally the security market is also divided into two parts: the primary and the secondary markets. The security market deals only with the sec- secondary market, that is buying and selling of securities already available in the market. On behalf of the bank, the dealer may also participate in the primary auction of the government securities and the T-bills conducted periodically by the RBI. So treasuries are totally active in equities, may also have a dedicated equity dealer who would be dealing in the equity instruments also. The primary market is for the corporate debt comprises of new issues of the non-government debt paper, which is not commonly referred as a non-SLR security. So normally the banks or the treasury never go for the non-SLR securities. It goes in for the securities that are issued by the government, which are or can be used as a SLR security. The front office also handles execution of deals and is in no way involved in the settlement processes of the deals executed by them. So, what is a back office? It is responsible for the verification and settlement of the deals concluded by the dealers. The deals are verified on the basis of a deal slip prepared by the dealers and also from the confirmations received from their counterparties. The back office confirms the deals independently with the counterparties over the phone or digitally and verifies the authenticity of the confirmation document. The back office also takes care of all related bookkeeping and submission of periodical returns to the RBI. So, back office is the main office which also maintains and reconciles all the nostro account, that is the foreign currency account with the correspondent banks, and also the funding and the security accounts with the RBA, and the demat accounts of the depository participants, and ensures that adequate money margin is being held with the CCIL, that is the Clearing Corporation of India, for the money and the dollar, for the rupee and the dollar settlements in India. So CCIL maintains a settlement guarantee fund by collecting the margin money from these treasury branches or the back office, and constitutes in order to avoid payment failures by the bank. What is in middle office? The mid office sits in between the front office and the back office. but we learn about it in the last period. It is the main one which looks after the risk management. The mid office involves activities related to monitoring and managing various types of risk. That includes the market risk, the credit risk, the operation risk, and the regulatory compliance of all the processes in the office. The mid office analyzes the potential risk associated with the financial transactions executed by the front office and works to implement risk management strategies. This function helps to ensure that the financial institution operates within acceptable risk parameters and complies with the regulatory parameters also. So the mid office or the office that deals with the risk, it totally looks after all the types of risk that are or that can arise in the treasury department. It is created exclusively to provide information to the MIS, the management system, and implement the risk management system. So it also monitors exposure limits and stop loss limits of the treasury and reports to the management on all key parameters of the performance of the treasury. The transfer pricing mechanism is also implemented through the mid office. So as per the RBI guidelines, the mid office should comprise of the experts in the market risk management, economists, statisticians, and general bankers who are functionally placed directly under the Asset Liability Committee Office, the ALCO. So, what is an investment department? The investment department is often a distinct entity within a financial institution that is responsible for managing the organization's investments. As stated earlier, this deals with the primary issues which normally a treasury doesn't deal with. But the investment department of a treasury deals with the primary issues. Whenever a suitable offer is received, the department would put up an investment proposal and obtain an approval at the appropriate level, wherein the minimum marketable investment being rupees 5 crore. So the initial or the minimum investment done by the investment department is 5 crore. So this department is involved in making strategic investment decisions, asset allocation, and the portfolio management. The professionals in the investment department may analyze market trends, the economic indicators, and the financial instruments to make informed investment decisions that align with the institution's goals and the risk tolerance also. Something like that of the mutual fund, wherein you do have a portfolio manager. So this investment department is a portfolio manager for a treasury. You can take it as an example. I'm not saying that investment department is a portfolio manager, but it does the work of a portfolio manager. The investment department also contributes to overall financial performance and the growth of the institution by optimizing the return on the investment source. To sum it up, treasury also maintains a ALM book, which is to be clear, a merchant book, and a trading book, corresponding to its role in the balance sheet management, merchant services, and trading across the currency and security markets. So, with this, we sum up our session. Do not forget to like, subscribe, and share our channel, Brilliant Bankers. Any questions on the video, please feel free to leave them in the comment section. Your feedback is invaluable to us. Your feedback is valuable to us. Once again, do like, share, and subscribe our channel, The Brilliant Bankers. This is Nishant signing off. Have a great day. Jai.